Welcome to Wealth Creation Investing's Monday Market Outlook. I'm Matthew Buckley, the Chief Investment Strategist here at WCI. And before we get started, folks, just a quick reminder, Wealth Creation Investments, if you're interested in our managed account service offered by Wealth Creation Investments, you can go to wealthcreationinvestments.com and click on Managed Accounts, and you can get all the information about how to open a managed account with Wealth Creation Investments. We did a couple webinars last week. There's been a lot of interest, and we appreciate all the interest. If you sent us your information, we're processing it, and we're trying to get your account opened as soon as possible. And we can do IRAs, 401ks, joint accounts, individual accounts, you name it. It most likely can be managed. So again, you can go to wealthcreationinvestments.com or email us at info@wealthcreationinvestments.com. Okay, let's get started here, folks. Compared with last week, obviously with the jobs numbers on Friday ticking up to 7.6%, the unemployment rate, but creating 175,000 new jobs. This week's kind of a yawn. Monday's a yawn, Tuesday's a yawn, Wednesday kind of a yawn. We're going to get our budget balance, but Thursday, obviously weekly unemployment claims, but we're going to start getting a look at the retailer, core retail sales, regular retail sales, and some import prices as well, and business inventories. But Friday's going to be kind of the big day this week as far as macroeconomic data. Core PPI and regular PPI, along with our cap utilization rate, industrial production, and the all-important University of Michigan Consumer Sentiment Report. Now, if you've been following the UM report at all, you know that it's kind of been hit or miss, but of late, let's go ahead and click the revisions in here as well and see how we've been doing in 2013. December kind of fell off the cliff into January, saw some strengths in February, which was kind of an anomaly, but look at this. Boom. Just blew it out of the water for May, which is just ginormous, and obviously they raised the bar even higher. So we're going to see on Friday if the consumer, their expectations are getting better. It will definitely move the market, and why? It's about 500 consumers, and it asks them about their current level and future level of economic conditions. It's kind of a how goes it of 500 consumers, which it's not a ginormous sample, but it's good enough to throw the market around in a couple directions. I thought this was an interesting chart I wanted to share with you. I mean, obviously on Friday with the jobs numbers, good news was good news, and bad news was good news. Right? The Fed's going to hang around, folks. So this market is going to keep going up from here. But look at this. The way we're currently going forward with this market, look at where the market needs to be based on earnings per share forecast if we're continuing, if you extrapolate the market at its current rate. If that makes any sense to anybody, it doesn't make sense to me. The math just doesn't work. And really good article on Zero Hedge here about the good, the bad, and the ugly as far as tapering scenarios from the Fed. The good is that if we're seeing good news, the market is seeing good news out of the economy, and the Fed is kind of easing off because the economy is good, well, that's a good. Then the market isn't going to implode when the Fed tapers, because the market's going to say, well, they're tapering because they're seeing good stuff going on. The bad news taper, which I couldn't agree more, is the Fed, the Bernanke, and a couple of the governors are starting to scratch their head and rub their beards and say, you know what we're doing might kind of sort of be damaging the stock markets, the economy, and just people's confidence in us in general. So very, very interesting with the bad news. And the not so timely taper, let's call it the good, the bad, and the potentially ugly, is the Fed sending a message, or floating trial balloons, or small tapering, trying to be half pregnant, so to speak, trying to say, well, the economy is kind of good and we're kind of creeped out about what we're doing in the economy, so let's kind of pull back a little bit. I think that's going to creep the hell out of the market if they do that. So that's going to be the discussion going forward in the market, I think, is what kind of taper this is going to be. A good taper, because the economy is actually getting better. A bad taper because the Fed's like, well, the suicide mission just isn't working. Time to bail out of this kamikaze. Or we got to muddle out of this thing taper. So very interesting to see what's going on there. Thought this was interesting. As everybody's fleeing from Japan, George Soros is actually shorting the yen and going long the stock market. I have a big position in one of my model portfolios in the EWJ, the Japanese ETF, which saw 5 600% gain in about 6 weeks, and then gave all of it back as the bond market imploded over there. But very interesting. Guys like Soros, Buffett, all these guys aren't rich because they're idiots. When the room empties, when somebody else fires and there's an absolute stampede out, these are the type of guys who walk in the room and look through all the purses and what everybody left behind and drink all the half-full drinks there. So very interesting. I'm actually looking at my EWJ position and adding to it because the Nikkei and the Japanese market is in bear market territory. And again, folks, nobody rings a bell at the top of the market. Nobody rings a bell at the bottom of the market. But I kind of hear some ringing over in Japan. And if you're going to get bullish on Japan and think that they're going to pull out of that nosedive and the Bank of Japan is going to do what our Fed's doing and just keep printing yen until the cows come home, then you got to be bullish on Japan, in my opinion. One last thing before we go here. Had it put on a trade last week, I think it was Wednesday, a bearish double vertical on the VIX. So bearish on volatility. It's up 350% in about 3 days, about $1,800 in profit there. $1,750, up 350%. And this was just a trade saying that volatility was going to implode. Why? Well, check this out, folks. Volatility does not stay elevated for too long. When the market runs for protection, it gets it, and then vol comes back to its kind of resting heart rate. I call it around 12.5, 13. We've had a freak out recently, and now it's starting to head back down to its resting heart rate. You can let's go out to 6 months and take a look at this. There's the fiscal cliff freak out. Well, we knew they were going to kick the can down the road and show no leadership. So I did a bullish double vertical here, bearish double vertical here. Here was a freak out in February. Vol spiked, and then it came all the way down crashing. Another spike right here. As you can tell, look, you can almost set your watch to it that almost once a month the market's going to freak out about something. Volatility is going to spike, but when it does, it doesn't stay elevated for too long. The analogy I use is vol doesn't stay at a 10-degree incline and run at 10 miles per hour on a treadmill. Even I can't do that. I can do it for a little bit, as evidenced by this, but then you got to get back to your resting heart rate eventually. So that was a really great trade, is a great trade in the primary trade alert model portfolio. And if you're interested, you can take and see how this trade's going to work out. You can take a test flight in our trade alert service over at Top Gun Options. Just hover over services and go to trade alerts. Or if you're an old man like me, you can go to topgunoptions.com/trade-alert-trials. And if you just want to hang out with me for 2 weeks in the primary trade alert service, you can just go ahead and click on that square. If you want to hang out in our intermediate advanced trade alert service, a little more intermediate and advanced tactics, you can go ahead and click there. But obviously most people, if they're going to hang out for 2 weeks and do a 2-week test flight in our trade alert service, they do obviously both of them so they can find that porridge, which one's just right. And again, this primary trade alert model portfolio is up $19,605. And based on $100,000 model portfolio, it's about 40. We're seeing about a 40% return year to date in our primary trade alert model portfolio, with the S&P being up about 15-16%. So seriously outperforming the S&P 500. So very happy with what's going on in our primary trade alert model portfolio. So if you want to give it a test flight, go to topgunoptions.com/trade-alert-trials and come check it out. All right, guys, I got to run. Have a great Monday. Happy hunting. Make sure you hedge, and I'll be back with you all for Friday's market wrap-up. We'll see you.